Back with the RS Exchange this Tuesday, the 15th of April. The South Africa's Reserve Bank has released its latest monetary policy review report. The new document outlines recent economic developments within South Africa, as well as key decisions and outlook on the economy and the financial system from the angle of the central bank, that is. Let's listen to the Reserve Bank Chief, Lesetja Kganyego, and others at the report presentation.
We meet here today when the world economy is in economic turmoil. The confidence regarding global economic developments we projected in October has largely evaporated. And this has been displaced by heightened economic uncertainty due to trade tensions. Here at home, we have seen significant progress on disinflation since last October, along with notable headway on the energy and logistics front. With inflation and inflation expectations better behaved, we lowered borrowing costs, and this will support economic activity. However, risks to domestic inflation and growth have risen markedly since the start of the year. The South African Reserve Bank remains steadfast in its commitment to protecting the purchasing power of the rand. We do this by ensuring that inflation and inflation expectations are anchored and price stability is maintained. As the South African Reserve Bank, we contribute to growth and employment mainly by reducing macroeconomic and financial instability. And this we do such that we create a more conducive environment for conducting business in our country. We will remain cautious as we navigate a highly volatile global macroeconomic environment. Here is one fact we know to be true. South Africans, and indeed consumers the world over, hate inflation. Importantly, high inflation is anti-poor. We at the South African Reserve Bank take our responsibility to protect the poor seriously. We, however, contend that while inflation has come down appreciably, our relatively high target is inconsistent with price stability, our constitutional mandate. True price stability is achieved when households and firms stop paying much attention to inflation when making consumption on investment decisions.
We're starting with watch your step, basically watch out where we're going because the world is uncertain. Clearly, the uncertainty is in that global environment. Current conditions look hard to read. Policy is equally hard to read, and that gives rise to a lot of uncertainty about the trajectories that our economies will go on and what policy trajectories need to look like. Global disinflation has slowed. One might argue that it's even stalling. And the open question here is whether or not that will start to reverse. There are certainly signs of it and shocks that suggest it. Global growth itself is modest and arguably fragile, and there are large downside risks staring us in the face. This is likely to lead to stagflation, and stagflation is a set of conditions in which the policy path that governments and central banks need to embark on becomes more uncertain. The policy rule that you want to take is not very clear cut. Domestically, growth has been very inconsistent, but we see it lifting gradually, and I'll talk a little bit about why that's the case. Inflation, this is the good news part of it, has been contained for some time now, and the forecast, the outlook looks moderate. Rates have been lowered by 75 basis points, and the stance now is above neutral, but close to it. There are, however, a wide range of risks that lead to quite low forecast confidence, and you will pick that up from our monetary policy statements in recent times. So let me move on to a few slides about the global economy and then to the domestic. So I'm going to go through these slides pretty quickly. I've got quite a few of them, so I'm not going to be, unfortunately, as succinct as I'd like to be, but I will go through the slides pretty quickly and just draw your attention to the things that really matter here. In this slide, this is just global inflation. We'll start there. And you can see those blue columns show you what the global inflation outcomes have been relative to the 2010 to 2019 average, which is the dotted white line. And then the October 2024 forecast, which is on the far right-hand side, that's that white circle. In October, we expected global inflation to continue falling, and the outcome is the blue level. So there's about a 1 percentage point difference, roughly half a percentage point difference between global inflation outcomes for 2024 and what we thought was going to happen in October. A lot of that is being driven by inertia from core inflation, which remains quite high above targets in most advanced economies. That's what I'm showing you in this graph. You can see again on that far right-hand side, there's been lots of disinflation, but those yellow, green, red, and blue lines are not closing in on that 2% inflation target, and that's been a concern for some time. Inflation is also stubborn in a range of emerging markets. Here I'm showing you Chile, Mexico, Poland, Brazil, Colombia, and Romania. And all of them, as you can see, again, have seen quite a lot of good disinflation. So those numbers of all those lines have all come down, but they've plateaued, again, considerably above the average 3% inflation target, which is that white dotted line cutting across there. So again, in emerging markets, we've seen some stalling out of the disinflation process.